to this penultimate session of this 2-day National Text Convention. Saurabhbhai, we have been throughout the 8 sessions and this is the 9th one. And as usual, I am here again for the purpose of introduction of the subject, which is the recent judicial decisions, so I have nothing to say on that. And as far as the faculty for the day is concerned, only a 2-word introduction, Mr. Saurabhbhai Soparkar. I present before you Sir Saurabhbhai Soparkar. I request Deep to kindly offer the bouquet and memento to Saurabhbhai.
Mr. Chairman, sir, my distinguished co-speaker Dilip Bhai, Shri Motorwala, friends. It's a pleasure to be here this evening in the last part of 2-day seminar, and I must compliment all of you to stay till the end, because by now attendance is over, the CPE hours are over, and I'm sure everybody is waiting to go back to office, so or start weekend. So let me be very brief. So we were waiting for Saurabhbhai. Thank you. I'm happy. Thank you. The topic for the day, so far as I'm concerned, is recent judgments of Supreme Court and High Court. And the issue that I intend to discuss would be from the perspective of how a particular judgment or a set of judgments would be useful to one and all in the matter of day-to-day practice. Therefore, there have been judgments in recent past which may be of a significant nature, but if the law is already amended years back and has no ramification today, there is no purpose in discussing them. Therefore, the concentration is on those judgments which still continue to have some bearing, some importance, some relevance, instead of discussing judgments which are now almost academic in nature. Secondly, instead of discussing, let's say, 50 judgments in 50 minutes or 60 minutes, which only means I will be referring to the head notes, I would rather discuss 6-7 judgments, take you in greater detail, find out what the principle laid down in these judgments is, and how is it that the same will be useful to us, or how is it that it is likely to hit us somewhere in the matter of assessments which may be pending originally or at the appellate stage. So the idea is to discuss a few judgments in greater detail instead of discussing or at least referring to large number of judgments without discussing in greater detail. With this preliminary observation, let me start dealing with some judgments, initially topic wise and then 1 or 2 judgments on a standalone basis. I first take the judgments dealing with one of the most important topics of the day, namely disallowance under section 14 capital A. Ever since section 14 capital A has been introduced, all SSs have problems in the matter of A, as to whether section will apply, B, if section will apply, how do you work out the disallowance. Therefore, the idea is over here is to find out how does section 14A, disallowance of expenditure incurred for the purpose of earning exempt income, will have to be found out, computed and ultimately worked out. Section 14A originally did not get quantified by way of rule. It is only in assessment year 8 and on and from assessment year 8-9 that we have rule 8 capital D, which deals with computation of disallowance under section 14A. I will very briefly go to how the law was perceived prior to rule 8D, and then I will take you forward on and from assessment year 8-9 when rule 8D has come into play to find out to what extent introduction of rule has brought about a qualitative change in the matter of interpretation of law. As we are aware, Rule 8D is in two parts. One, disallowance of expenditure of interest on the funds borrowed for the purpose of investment, and second, disallowance of administrative expenditure. Let's concentrate first on the interest part. In order to be able to suffer disallowance under section 14A in relation to interest, there has to be payment of interest on the funds borrowed. More often than not, or mostly in every case, there is no direct linkage between borrowing and investment. If there is a direct linkage between borrowing and investment, surely interest that you pay on the funds borrowed to make investment into shares which give you exempt income becomes a simpler issue, and probably you may not have much of a defense there. But where you have a mixed funds, you have significant own funds, significantly borrowed funds, and on the other side, on the asset side, there are investments for business, there are investments in the nature of interest bearing or tax interest bearing funds, there are investments which give you non-taxable or exempt receipts. How do you work out? Question arose for the first time before Gujarat High Court in the case of Raghuvir Synthetics 354 ITR 242 in relation to section 3613. 354 ITR 232, where SSC had given interest-free funds to its associate concern. Argument of the revenue is that you are paying interest on the funds borrowed by you and you are not charging interest on your associate concern, therefore we will disallow the interest. The SSC said that, sir, I have, let's say, capital of rupees 50 lakh, reserves of rupees 30 lakh, and I have given rupees 25 lakh to my associate concern, therefore assume that I have given my funds out of my own funds, my own capital plus reserve. I have not diverted interest bearing funds for non-interest bearing purposes. Tribunal upheld it, and on this basis the tribunal said that if SSC has interest free funds more than what he has given free of interest to an associate concern, section 3613 would not apply. Taking clue from that argument, subsequently it was argued before the tribunal in relation to section 14A that if I have more interest-free funds available to me as compared to investment, then no disallowance in relation to interest would take place. Tribunals series, but at least Ahmedabad tribunal started accepting it without there being any reservation, and therefore the lead judgment on the point is thereafter when the matter went to High Court, Suzlon Energy 354 ITR 630, Torrent Power 363 ITR 474, UTI Bank 32 Taxman.com 370, all these judgments taking a view that if you have more interest free funds than what you have given, no disallowance under section 14A will be possible. This was possible to argue without much of a problem prior to or up to assessment year 7-8. Then came assessment year 8-9 and rule 8D is brought into statute on the rules. The argument of the revenue was that hitherto maybe the principle of general funds may be possible. But now that you have rule 8D, which clearly says expenditure directly linkable, disallow, to the extent expenditure cannot be directly linked, apply the theory of proration, interest paid over the interest-free investments or tax-free investment upon total of the asset side. That formula will have to be automatically applied. Delhi High Court had probably accepted that particular theory, that all judgments of different courts dealing with disallowance prior to assessment year 8-9 would not continue to be taken as a good law on and from AY 8-9 because of invocation of rule 8D. However, Gujarat High Court in a judgment in the case of India Gelatin 376 ITR 553 again reiterated that notwithstanding Rule 8D, if the funds that are generally available to the SSE as interest-free funds are higher than the amount invested, even now SSA will not suffer disallowance under Rule 8D in relation to interest. In other words, the theory of mixed funds resulting into automatic disallowance under Rule 8D continues to be negatived by Gujarat High Court even post Rule 8D insertion. This is certainly a very good step in the right direction, because after AY 8-9 there was a fear that old judgments would not be helpful to the SSA and the SSA will have to suffer disallowance. That may not really happen now by virtue of this judgment of Gujarat High Court. This has been thereafter consistently followed, explaining that the judgment of Bombay High Court in the case of Reliance Utility 313 ITR 340, which again lays down principle that if I have interest-free funds and interest-bearing funds, I must first apply interest-free funds for the purpose of investing into shares, and therefore I will not suffer disallowance till I exhaust interest-free fund. That is held applicable even for the purpose of section 14A. Therefore, in relation to the payment of interest, now the things appear to be settled in relation to at least state of Gujarat, that interest-free funds, if you have, you would not have to suffer disallowance under section 14A in relation to interest unless the interest is directly linked. If it is not linked, then on a pro rata basis, you will suffer no disallowance. Let me go to the second component as regards administrative expenditure. As regards administrative expenditure, again, prior to insertion of Rule 8D, the view taken by the Gujarat High Court was that unless it is found that actual expenditure is incurred, no disallowance would take place. Gujarat High Court took the view in case of Torrent. Kerala High Court took the view in the case of Catholic Syrian, 207 Taxman, page 2. Delhi High Court took the view in the case of Maxop, 347 ITR 272. So the view up to AY 8-9 was pretty clear that you will not have to suffer disallowance of any expenditure unless it is established that as a matter of fact some expenditure is incurred. Now that most of the dividends are received directly in the bank account, one can easily argue that there is no collection charge in relation to dividend. There may be some expenditure in relation to managing your investment, but otherwise there is not something which is significantly required to be spent by you year after year if your investment portfolio remains static or without there being any ups and downs. So up to AY 8-9, there is, I believe, not much of a problem. After assessment year 8-9, on and from assessment year 8-9, Rule 8D, there being on the statute book under income tax rules, I don't believe that I can say ignore it. Nonetheless, the courts have been taking a view that if SSE can establish that as a matter of fact expenditure incurred by him is quite less, then without applying the theory of proration, it may be open to SSE to claim my investment is at a 0.5% is, let's say 50 crore, 0.5% comes to rupees 25 lakh. But if I can show that as a matter of fact my expenditure is not more than 3, 4, 5 lakh of rupees, maybe you will have a right to contend that expenditure disallowance will not exceed that particular amount. This is one part of the controversy. Let's now consider section 14A, some other independent controversies. Each one of them is having a different facet and interesting facet. I borrow rupees 1 crore at interest at 10%, pay interest of rupees 10 lakh. I invest into shares of a company, but I do not get any dividend from that particular company. Therefore, I have no exempt income. Language of the section is expenditure incurred for the purpose of earning exempt income. I have earned no exempt income. I have incurred expenditure for the purpose of earning exempt income. If yes, I must lose. Or is it that till I actually earn exempt income, I will suffer no disallowance? In other words, in this case, though I have paid an interest of rupees 10 lakh, in as much as I have received no dividend income whatsoever, I have no exempt income, do I still suffer disallowance of rupees 10 lakh out of my total expenditure, or can I claim that if there is no exempt income, there will be no disallowance? As an accountant, I found it a little difficult proposition to accept, but now I find series of high courts, including Gujarat High Court, have accepted the theory that if you have no exempt income, there will be no disallowance whatsoever. The lead judgment is of Punjab and Haryana High Court, Winsome Textile 319 ITR 204, followed by Gujarat High Court, Coretech Technology 372 ITR 97. I had my reservation because in these two judgments, the judgment of Supreme Court in the reverse situation was not discussed. If you recollect, at some stage dividend was taxable. And at that time, SSs used to argue that interest on the funds borrowed by me for the purpose of earning dividend income should be allowed. Revenue used to argue that if you don't have dividend income, no expenditure will be allowed. Supreme Court in the case of Rajendra Prasad Moody took the view, 115 ITR 519, that even if you have no exempt income, even if you have no dividend income, expenditure would be fully allowed to you, because what is important is the purpose of borrowing and not as to whether you actually earned the income or not. This Rajendra Prasad Moody's judgment was not discussed either by Punjab and Haryana High Court or by Gujarat High Court. So I had my reservation as to whether, if that judgment is really discussed, would the answer be different. But then I find the Delhi High Court in the case of Cheminvest 378 ITR 33 has discussed the judgment, distinguished the judgment, and taken a view that unless you have exempt income, the question of disallowance would not be there. In other words, now that I borrow rupees 1 crore, pay interest of 10 lakh, if I do not want to have any disallowance, maybe a day before the share is likely to yield me dividend, if I transfer the share, and if I have no exempt income during the year, I can easily escape disallowance under section 14A. Bombay High Court, in a very, very small unreasoned judgment of Delight Enterprise, ITA 110 of 2009, also took the same view. However, it was a 3-line judgment without carrying much of the reasoning. So now we have covered the situation of borrowing of rupees 1 crore, payment of interest of 10 lakh, no dividend, by virtue of this judgment, no disallowance. Let's go to the next scenario. I borrow rupees 1 crore, pay interest of 10 lakh, I receive dividend of rupees 50,000. If I would not have received any dividend, I would have suffered no disallowance. Now that I have received dividend of rupees 50,000, do I suffer disallowance? And if so, do I suffer disallowance of whole of rupees 10 lakh, or is there any other answer? Now that I have earned dividend income of rupees 50,000, which is an exempt income, I cannot argue that unless there is an exempt income, no disallowance. Therefore, that argument is not open to me. Therefore, SSC started arguing that, sir, expenditure incurred for the purpose of earning exempt income, and therefore expenditure to be disallowed for the purpose of section 14A cannot exceed the exempt income. Therefore, I have paid interest of rupees 10 lakh. However, in as much as I have exempt income of rupees 50,000, do not disallow beyond rupees 50,000. If you ask me logic behind this argument, frankly there is none, except to say if exemption is 50,000, disallowance cannot exceed rupees 50,000. However, that argument was floated, and it first came to be accepted by Bombay Tribunal in the case of Daga Global. Then it was accepted by Chandigarh bench of the tribunal in the case of Punjab State Cooperative, Delhi bench in the case of Sahara India. Following that, Ahmedabad bench in the case of Jivraj Tea, everybody stated disallowance cannot exceed the exempt income. Why? That is not really seriously discussed, except on a logic that if your income itself is 50,000, where is the question of disallowance of anything above rupees 50,000? And this is not enough. Now, Delhi High Court in the case of joint investment 372 ITR 694 has accepted the plea. The total expenditure to be disallowed cannot exceed the exempt income. Again, if you ask me, except for making this statement in a little elaborate manner, the judgment does not give much of the legal foundation to support this edifice. Nonetheless, this is the judgment of the High Court, clearly saying expenditure cannot exceed exempt income. Therefore, in the second scenario where I have earned income of rupees 50,000 and if I have paid interest of rupees 1, let's say 10 lakh, what I will suffer disallowance is rupees 50,000 and not a sum of rupees 10 lakh. Third scenario. I have invested into shares of a company, but these are not my regular investments like Tata, Reliance or whatever, blue chip companies. I have invested into shares of a company which are A, my subsidiaries, or B, strategic investment, or C, special purpose vehicles for the purpose of carrying out certain projects. Is it that section 14A would apply where the investment is not in the form of investment to earn income on a regular basis, but investment is made for the purpose of carrying out business operation in a particular systematic manner, and therefore the monies are invested in the form of strategic investment and or subsidiary investment? Again, if you ask me, where is the distinction in law as regards the purpose of investment? There is none. Section 14A or Rule 8D do not say that investment in order to suffer disallowance should be of a general nature and not of a special nature. However, the beauty of Income Tax Act is people are tempted to make all kinds of interesting arguments, and more important, all kinds of interesting arguments get accepted by some logic or other. So, there was a theory that, sir, 14A will not apply where I have put in money in my subsidiaries, because I put in my money in my subsidiaries not to earn dividend income, but for the purpose of carrying on business through subsidiaries. That argument gets accepted by Calcutta Tribunal in the case of Selwell Private Limited, 58 Taxman.com 196. It gets accepted by Delhi Tribunal in the case of Intra Globe ITA 1362 of 2013. In couple of other cases, the argument is that, sir, what I have invested in is not my subsidiary, because subsidiary would mean at least 51%. I have put in money in companies where I have a controlling interest, maybe by a subsidiary or otherwise. And the theory of controlling interest also gets accepted, firstly by Mumbai Tribunal in the case of Garware Wardrobe, 46 Taxman.com page 18. And recently by Kolkata Tribunal in the case of Batliwala and Company, 159 ITD 924. In case of special purpose vehicle, Chennai Tribunal in the case of L&T Infra, 37 ITR 80, Chennai has taken a view even special purpose vehicle investment will not suffer disallowance under 14A. If you ask me very plainly, from where do I get distinction between normal investment versus this special purpose investment, joint venture investment, subsidiary investment? There is none. But then a law is developed that 14A would have to be restricted to only normal investments and not this kind of specialized investment, and therefore if it is worth it, maybe it is worth carrying this argument. At some day High Court and or Supreme Court will settle the issue. Till then it is worth taking a chance on this particular issue. One more facet before I go to other hazards. If I invest into shares of a company which give me tax-free income, but that investment is not held by me as investment, that investment is held by me as stock in trade, do I suffer disallowance under section 14A? The argument is this, that 14A is for the purpose of ensuring that people don't have exempt income and yet claim expenditure which they would incur for the purpose of exempt income against other income. In case of investments in shares, dividend income is exempt, and if it is long term, even capital gain is exempt. Short term capital gain is being taxed at a concessional rate. However, if I am holding shares as stock in trade, then dividend income is taxable, is exempt, but rest of the income, namely profit on sale of share, would be taxable at the appropriate rate or normal rate. Therefore, the argument was that 14A would not apply where you are holding investment not as investment but as stock in trade. Again, if you look at section 14A, no such distinction. Rule 8D, no such distinction. But then Karnataka High Court in the case of CCI 206 Taxman 563 takes a view that 14A would not apply where investment is into shares not as investment but as stock in trade. I must also point out the contrary view of Kerala High Court in the case of Leena Ramachandran 339 ITR 296. Between Karnataka and Kerala, Karnataka is a detailed judgment, Kerala is almost ipse dixi, though I would personally believe Kerala is a better view, but nonetheless Karnataka is a more discussed view. In matters at Ahmedabad, tribunals have taken a view in favor of SSE, matters are pending at the Gujarat High Court. Following this, some bench of Bombay Tribunal takes a view in favor of SSE, some bench of the Bombay Tribunal takes against the SSE, therefore it is free for all, whoever wants to take whichever view, now it is being taken. But this is one possibility which one can think of, and in a given case apply the principle that to stock in trade also section 14A would not apply. One more controversy. 14 has numerous controversies, but all of them are live controversies, though therefore I intend to discuss in little greater detail. Section says, 14A says, if I have got, now let's assume that I have mixed funds, I am paying interest, investment is of a regular nature, therefore 14A computation will have to be made by me. My P&L account shows that I have paid interest of 1 crore 10 lakh, so expenditure of 10 lakh. But then I also had some surplus funds which I had invested, and therefore I had earned interest income of, let us say, rupees 6 lakh. Therefore my net interest expenditure is rupees 4 lakh. Do I compute section 14A on the gross expenditure of 10 lakh of rupees, or do I compute interest 14A on the net interest expenditure of rupees 4 lakh? Go a step forward. I have paid interest of 10 lakh, but I have earned interest income of 12 lakh. Then because my interest at the end of the day at the foot of account is rupees 2 lakh surplus, is it that I will not suffer any disallowance because I have not paid actually any interest? At the end of the day I have received interest. Again ask me, from where do I get the theory of netting off? There is none. But interest paid, wherever the word paid is appearing, recall ATHHC Supreme Court ABG, interest paid was taken as net interest. Based on that, now a theory is developed that if you are disallowing, don't disallow on a gross interest pro rata, do net interest and then do pro rata. It started with Morgan Stanley Bombay Tribunal, followed by Delhi Tribunal in the case of trade apartment, Ahmedabad Tribunal in the case of Nirma, ITA 980 of 2012 accepted this. Matter was carried to High Court. I thought High Court would examine the issue from this angle of gross versus net because it's an important angle. Fortunately for the SSE, this angle was neither presented by the department's counsel nor High Court on its own really looked into the matter from this angle, and therefore on the ground that SSE has paid interest but also received interest more. What happened was, in that case interest received was more than interest paid. So SSE said, I have not paid any interest whatsoever. High Court said, the tribunal said, as there is no interest paid on net basis, no disallowance. And the matter got confirmed by High Court. Therefore, one can argue, at least in the state of Gujarat, Nirma now being accepted by, Adani now that it is accepted by the High Court, one can say the theory of netting off is accepted by the Gujarat High Court, if not expressly, but impliedly. Therefore, netting of interest is also one argument that requires consideration. One more angle. Assume that I have paid interest and I have to do disallowance. How do I work out? The theory says interest paid upon proration, investment upon the assets. Now when I take interest paid, what is the amount of interest that I would take apart from that netting, etc., etc.? Let's say I have paid interest of rupees 50 lakh during the year. 10 lakh of rupees is paid directly for 14A investment. 25 lakh of rupees is paid by me towards term loan for the purpose of investing into plant and machinery. And further amount of 15 lakh of rupees is general interest paid on a cash credit account or overdraft account which is utilized everywhere. Now first rupees 10 lakh, because it is a direct expenditure, will have to be disallowed. Then comes next 40 lakh of rupees. Do I prorate 40 lakh of rupees or do I not prorate 40 lakh of rupees? Argument before Delhi High Court was on the theory of proration, just as you allocate direct expenditure to investment, similarly direct expenditure to taxable activity, 25 lakh of rupees paid by you for the purpose of manufacturing activity which is taxable would have to be excluded, and what is appearing then in a hodgepodge account or a mixed account, that alone will suffer disallowance. So in the present case, disallowance not on rupees 40 lakh but on the amount of rupees 15 lakh. Delhi High Court in the case of Bharti Overseas 237 taxman 417 has accepted this, which I believe is certainly a step forward, and there is, I believe, a logic in it, has accepted this theory and stated that while you are disallowing, disallow only that part which is a part of a common borrowing. Extent of borrowing which is dedicated to earn taxable income shall not be computed for the purpose of section 14A, and because section 14A is allocable to on a pro rata basis on a lump sum borrowing and not on a dedicated borrowing. Two more issues and I will close. First on 14A. Expenditure incurred for the purpose of earning exempt income. Which is the exempt income that we are talking about here? Is it exempt income under section 10, 11, etc., chapter 3, or are we talking about exempt income also under chapter 6A, ATIA, ATIB, ATHSC, etc.? Revenue argued that even income which is exempt under chapter 6A is also exempt income, and therefore we will invoke section 14A even for the purpose of earning, for the purpose of section that earning for chapter 6A exempt income. Gujarat High Court rightly took a view recently in the case of Banaskantha District Cooperative Milk Producers Society 280 CTR 609. So also Delhi High Court in the case of Kripco 349 ITR 618, taking that chapter 6A deduction is not dealing with exempt income. They are deductions. They are not exemptions in the sense of exclusion from the charge of taxability. Therefore, section 14A would not apply there. And finally, in relation to 14A and MAT, this is again one gray area which is a burning area. Suppose I actually suffer disallowance under section 14A in the sum of rupees 10 lakh in my normal computation. Do I have to add back this amount for the purpose of MAT calculation? The argument of the revenue being any expenditure incurred for the purpose of earning exempt income will have to be added back for the purpose of MAT, because exempt income itself is excluded for the purpose of MAT. So if dividend income is excluded, whatever is expenditure hypothetically or theoretically incurred for the purpose of earning that exempt income should also be excluded. The matter was, okay, different tribunals of the different benches of different tribunals had taken different views. The matter was and probably continues to be pending before the special bench of Delhi Tribunal. In the meantime, Gujarat High Court in a matter in the case of Alembic Limited has accepted the contention of the SSC that disallowance under section 14A will not have to be projected for the purpose of MAT calculation. If you ask me the logic, I will not be able to supply logic, because you will only have to see the question and at the last page answer in favor of SSC. In between, I am not able to find out any logic, but High Court has accepted. The Department Appeal stands dismissed. So, and on that basis, we have been arguing now that issue stands concluded and tribunals have been accepting. And whenever they ask me, but where is the logic? I say, sir, I can't ask you logic, you can't ask me logic. High Court has held so, you must accept it. And they are bound to accept it. No, Alembic is not reported. There is nothing worth reporting there. If you want, I'll send it to you. But it's Alembic Limited. I can give you the details. Tax appeal number 1249 of 2014. So this takes care of the issues on 14A. Let me now go to another interesting topic, again series of judgments. Search 153A, 153C and related issues and related judgments. We had originally section 158 BC, BD, block assessments. They came to be substituted by this new sections 153A, assessments in search cases, and 153C, assessments in case of search not in the hands of the searched person but in the hands of a third person. Some issues have come up over here which require some discussion. Unlike old block assessment, which was a block of 6 years running parallel to the regular assessment to cover up regular income, block assessment to cover up only undisclosed income. Therefore, during that block period of 6 years, SSC will have two assessments, one normal, another block. Now under section 153A, there are no two assessments for the 6 years also. If there is a search, then assessments for the earlier 6 years lapse or they abate. They abate if they are pending. Question that arises is, two questions will arise. One, what will abate? And two, what would happen once they abate? Two different controversies. Take a situation, search takes place today. We are in December 16. So obviously in normal course, assessment for assessment year 15-16 would be pending. Assessment for assessment year 14-15 may also be pending. Assessment for earlier years may not be pending either under section 143.3 or under section 143.1. Assessments would have taken place. Question is, now there is an assessment for a period of 6 years. All pending assessments will abate. What is the meaning of the term pending assessment? Pending assessment would mean where assessments are not framed. Whether assessment under section 143.1 or technically intimation under section 143.1 would also be regarded as assessment or not. Because if they are also regarded as assessment, now under the new system, even assessment year 16-17 returns which are filed, some of us might have received intimation even for assessment year 16-17 also. The view of the department was that only section 143.3 order would be an assessment, not 143.1 order. But then now we have series of orders of different benches of the tribunal taking a view that section 143.1 assessment is also assessment. So that is also not to be regarded as pending. Now assessment, what is the reason why we need to make the distinction? The reason why I need to make distinction is, if assessment is pending, it will be assessed only under section 153A. If assessment is not pending, let us take a genuine case, assessment year 12-13, 13-14 is not pending, 143.3 assessment had taken place. Today there is a search. Would assessment for assessment at 12-13 and 13-14 will be redone on the ground that 6 years are not over from the date of search, on the date of search, or it would be redone only if any incriminating material is found. If you look at the language of the section, apparently the distinction is not very clearly brought about. However, the view appears to be that if at the time of search, books of accounts, etc., originally assessed were not produced, or if undisclosed income was found, then the assessment for the last 6 years is mandatory. Therefore, let me presume with this premises that if at the time of search or on search, incriminating material is found for one or more of last 6 years, assessment for one or more of those 6 years will certainly have to be redone under 153A. Question is, suppose at the time of search, no incriminating material is found in relation to assessments which are already concluded, would assessment abate, or would the revenue have a right to redo the assessment and make additions completely unconnected with the search? Take an example. assessment is framed, some claims are accepted, issue is over, it got concluded. Now that there is a search and assessing officer is toying with the idea of what to do with the earlier years, he finds something in the books, nothing to do with the search, something in the books, as a result of which he says, I will like to redo the assessment for assessment year 13-14, which is within 6 years, but for which there is no material found at the time of search. Or as are the facts of one of the cases, search takes place. At the time of search, no material is found. However, when the assessment is going on, somebody else is searched. And when that somebody else is searched, at the premises of that somebody else, some material is found dealing with this SSA, as if the SSA has paid cash. And therefore, assessing officer said, if not on the basis of your search, because the assessment is open, I will now frame assessment under section 153A on the basis of search in the case of somebody else. Is this permissible or is this not permissible? Apparently, the lead order or lead judgment was that of Delhi High Court in the case of Anil Bhatia, 352 ITR 639, where High Court apparently had laid down that once there is a search, assessment for 6 years is mandatory and assessment will have to be made for every of the 6 years. However, High Court itself had kept one issue open, which department was deliberately not reading. What High Court had said, here we are not concerned with a case where at the time of search no incriminating material is found, and therefore we are not opining on such a situation. Therefore, department without reading that part was saying once there is a search, there has to be assessment again. SSEs were saying that is not what the law is. If at the time of search no material is found, why should the concluded assessment be redone? Because ultimately search is for the purpose of unearthing unexplained income or extra income, concealed income. If you could find nothing in the search, you just can't make me suffer assessment again. Bombay High Court took the view in the case of Continental Warehousing 374 ITR 645 that assessments which are closed cannot be again done under 153A unless any incriminating material is found. Delhi High Court in the case of Kabul Chawla 380 ITR 573 again accepted that view, distinguishing Bhatia's case, that Bhatia's case was not dealing with a case where there was no incriminating material. Here is the case where there is no incriminating material. So Kabul Chawla's case, Delhi High Court said in such a case, no reassessment beyond within that period of 6 years, also under section 153A. Apparently, Karnataka High Court had taken a slightly different view. Matter recently came before Gujarat High Court. In a detailed judgment as yet unreported in the case of Soumya Construction, tax appeal number 24 of 2016, High Court accepted the view, accepted and followed the view of Delhi and Bombay and also Rajasthan. Rajasthan also taken the same view in the case of Jai Steel 36 Taxman.com 323 and took the view that if there is a search and if there are some assessments which are not pending, then in relation to those assessments which are not pending, unless there is an incriminating material, you have no right to redo the assessment and you cannot expect SSA to again suffer the pangs of assessment. The logic of the High Court, which is a very detailed and a beautiful judgment, is that you search a person because you believe there is an income which is not or would not be disclosed. Look at the language of section 132, where SSE, where the department has a reason to believe that SSE has money, bullion, jewelry, valuable article or thing which he is not or is not likely to disclose to the department. So 132 is meant to cover up those cases. If you have section 132 proceeding, you do not find out anything, then you must drop the proceeding. You cannot then tell the SSE that okay, if not anything at the time of search, independently also will assess you. Therefore, High Court has now accepted that assessment will not have to be again done in case of a concluded assessment if SSE has found, if there is nothing that is found against the assessment. There was a controversy in relation to section 153C which is partly resolved, but now there is another aspect which requires discussion. Let me first of all deal with the controversy resolved. Originally the language of section 153C was that if there is a search at the premises of, let us say, A, and if at the premises of A, at the time of search, any money, bullion, jewelry, valuable article or thing, or books of account or record belonging to B are found, then department has a right to proceed also against B under section 153C. Catchword was or catchphrase was belonging to, and therefore the controversy was whether the word belonging to will cover documents which do not belong to B, which are not owned by B, but which only refers to B. There is a builder who is searched, at the place of builder record is found to show the allottees have paid cash booking, paid cash for the booking. Now that is not a record of the allottee, it's a record of the builder. On the basis of that record, you may reopen the assessment, but you can't have 153C. That was the view taken by Gujarat High Court. Law is now amended, and therefore now the law says anything pertaining to or pertains to or is referred to found at the time of search can also entitle revenue to reopen. So that's okay. There is now that line of argument will go. But interesting argument is the law says that if at the time of at the premises of A anything pertaining to or belonging to B is found, and assessing officer of A is satisfied that it belongs to B, he must transmit the record to the assessing officer of B, who on being satisfied that it belongs to B will then start proceeding under 153C. Argument before the Gujarat High Court was that, sir, in this case, before you invoke section 153C, procedure needs to be complied with. What is the controversy? Mr. A was searched. At the premises of A, maybe the record of B was also found. Department, maybe by passing order under section 127, centralized cases of A and B. Now that the same officer was there, A and B had a common officer, assessing officer of A also started inquiry against B under section 153C. Before the tribunal it was argued, and then it was argued before the High Court that, sir, before you invoke section 153C, assessing officer of B must be satisfied that he has received record from assessing officer of A, who must be satisfied that income belonged to B. Therefore, there must be two satisfactions, one by AO of A, second by the AO of B, and in between there must be transmission of record from AO of A to AO of B. And therefore, unless there are two satisfactions, case cannot be taken up under section 153C. Revenue said, sir, but here the same officer is of A and B. So I can't write two satisfaction notes, one as AO of A and second time as AO of B. And record also cannot travel from my office to my office because I am the only one. High Court says second contention is right. There is no question of transmitting record from one officer to another because there is only one officer. However, High Court says that the first condition is equally important. You as officer of A must be satisfied that money, bullion, jewelry, etc. belong to B. So you must record that satisfaction in the record of A to note that everything belongs to B. Then you have to open the record of B where the record has gone and record satisfaction again. That record has come from the record of A, which would show that income, money, etc. belongs to B, unless you record satisfaction twice over, one as an AO of A, another time as AO of B, section 153C will fail. The judgment is in the case of Lalit Kumar Patel, 36 taxman.com 554. This is important because almost in every case where 153C action is taken by the same officer who is taking 153 action, you would find there is no double satisfaction. Because it is the same officer, he does not take trouble of noting satisfaction twice over. He would have ordinarily recorded satisfaction on the record of A, sent it to himself as OO of C, and would have just started proceeding under 153C. In all these cases, 153C are quashed by the High Court saying, unless there is satisfaction recorded second time, you will not be in a position to sustain proceeding under section 153C. Let me now go to some interesting development in the matter of revision under section 263. There is a development in law and there is also development in judge-made law. It's in the case of Amitabh Bachchan. Nothing turns on the name except to show how so-called good, high people, mighty people are also ill-advised. And it's the ill-advised which results into serious complication. Judgment is 384 ITR 200. Assessment area is assessment of 1-2. Assessee files return of income, then he revises return of income, then he again revises return of income. And in the second revised return of income, he says that SSC, being obviously high profile person, needs protection, no controversy there. And therefore, he has spent 30% of his receipts towards expenditure incurred for protecting himself, which should be allowed as a revenue expenditure. But in view of the fact that these are all confidential data, we would not be able to supply the information as to how the expenditure is incurred. So the claim was made of deduction of 30% of the receipts to serve the curiosity of human being. I must say that he had in that year receipt of rupees 3 crore and 10 lakh. Nothing turns on the mat, but 3 crore and 10 lakh. So the argument was about 1 crore of rupees I have spent on protection to myself, which must be allowed as an expenditure. EO said, sir, fine, please give the details of the expenditure. SS said, I can't give the details. EO probably must have said, then you cannot claim expenditure. Therefore, SSC then wrote a letter, I am giving up the claim of expenditure. Assessing officer closed the issue, framed the assessment. CIT took up the matter in revision. This is one judgment which lays down various principles, so I will go into little greater detail. Some of them are quite shocking and laying down principles which are important for the SSA because they are against the SSC. CIT issued show cause notice on 11 different issues. The show cause notice was issued on 7th November 2005 and ultimately on March 20, 2006, CIT set aside the assessment with a direction to do it again. Out of 11 issues raised by the CIT originally, he dropped 8. He retained 3, but he also introduced some new issues which were not covered by the show cause notice. So the order of CIT contained 3 issues originally raised plus some new issues never a part of show cause notice. Matter went to tribunal. Tribunal took the view in favor of SSA, quashing the order of CIT on the ground that the 3 issues which were raised by the CIT, they were not worth raising and therefore there is no substance in it. And other issues raised by the CIT were not subject matter of notice by the CIT and therefore they are beyond scope of section 263 and therefore those issues must also go. Therefore, order under section 263 was quashed. Matter was carried to High Court. High Court summarily dismissed the tax appeal. Matter was carried to Supreme Court. Before the Supreme Court, the first issue to be argued was on the scope of section 263. Argument of the SSC was that, sir, in relation to new issues which were not covered by the show cause notice, how could CIT pass an order? Supreme Court said, which law says that CIT has to give notice to you? And this is the issue which is important. Which law says that section 263 order must succeed a written notice? What is necessary for purpose of section 263 is opportunity of hearing. Meaning thereby, CIT must inform you. You means SSC, Chartered Accountant, Tax Practitioner. CIT must inform you the grounds on which he wants to revise assessment. There is no law that he has to give you a written notice. The SSC probably said, but sir, how do I know as to what is it that the CIT is going to do? Supreme Court says, CIT has worked on the basis of record. You knew what the record was. So how do you say you are not aware? I am not very sure what exactly Supreme Court is trying to convey. If Supreme Court is trying to convey that you should have the same thought as the CIT had, it's a different matter. Otherwise, unless I am told, either in writing or orally, that what CIT proposes to do, how do I know? But Supreme Court says, which law says you have to be told in writing? So long as you are made aware of it, which is essentially what is the record, nothing further is required to be stated. The SSC said that, sir, this kind of power cannot be exercised in every case. Supreme Court says, unlike section 148 where reasons for reopening are required to be recorded and now required to be communicated to SSC, section 263 has no such requirement. Power of the commissioner therefore is almost unfettered and unlimited. Supreme Court has used the word, there are no conditions precedent for exercise of such powers, and the Commissioner has unfettered jurisdiction in the matter of section 263. Supreme Court then said the assessee was having dilly-dallying tactic with the assessing officer, was trying to delay the assessment, and with the Commissioner's finding that ultimately assessing officer found he does not have sufficient time to frame assessment, and therefore he hurriedly framed assessment without really going into the fact, appears to be correct, and therefore assessing officer's order is bad because it is prejudicial. On a positive side, Supreme Court reiterates that the Malabar Industries judgment of Supreme Court, that there are two conditions precedent for invoking section 263. Order has to be erroneous insofar as it is prejudicial to interest of revenue. Error and prejudice is a must. But once two conditions are satisfied, the power is unlimited. Supreme Court also accepts the plea that if there are two views possible, then the mere fact that one view is taken by itself is no ground for revision. But the question is, are two views possible or not? And that has to be seen reasonably. Now comes, why did I start by saying that how maybe people who are otherwise capable of getting good advice also get wrong advice. The Supreme Court says, of the three issues on which CIT maintained 263, which were quashed by the tribunal, two we agree, there was nothing much. One issue, the issue that I discussed, was claim of 30% of expenditure. CIT said, fine, you are not claiming expenditure, good enough, don't claim expenditure. But now that you say you had spent the money, show us the source. And if you cannot show us the source, why would we not invoke section 69C? So SSA wanted to claim deduction of 1 crore, instead is left with addition of rupees 1 crore. Because if he cannot say I have not spent the money, his case was I have spent money. Now he is told if you have spent money, then you have to show the source of spending the money. SSC said, sir, I was wrongly advised. I was advised it is a standard deduction. I wonder as to how there can be standard deduction against professional receipt. SSC claimed a standard deduction. Supreme Court said, we don't really believe that. Once you have claimed it, department must examine this. And therefore, Supreme Court says, assessing officer, once he takes up the issue of the expenditure for protection of self, he ought not to have then left the issue at that stage. He should have made further inquiry as regards source of payment, and as he had not made the inquiry as to source of payment, the order is erroneous, prejudicial to interest of revenue, and therefore section 263 proceedings are permissible. In other words, now we find section 263 proceedings are very, very wide. Undoubtedly, Bombay High Court post this judgment, after discussing this judgment in the case of Nihar Modi 71, taxman.com 272 has stated that this judgment will be applicable in case of no inquiry. Therefore, if assessing officer has made inquiry and thereafter adopted a particular course of action, then the course of action adopted by the AO cannot be faulted for the purpose of section 263. I am not very sure to what extent the Bombay High Court judgment may be regarded as a correct law, but assuming it is a correct law, you will have to exactly bring out a case within that parameter of no inquiry. Coupled with the fact that on and from 1st June 2015, there is an amendment in section 263. Explanation is added in section 263, considering 4 situations where the order passed by the AO is found to be or is deemed to be erroneous insofar as prejudicial to interest of revenue, without making adequate inquiry when he should have made more inquiry, allowing any claim made by the SSC without inquiring into the correctness of the claim, order is passed contrary to direction of CBDT, or order is passed contrary to any judgment of Supreme Court or jurisdictional High Court. One question would arise as to whether this explanation is retrospective in nature so as to affect pending assessments, or it is not retrospective in nature. Left to me, I would take away it is not retrospective because it is not procedural, it is substantive. However, I must say that Bombay Tribunal in the case of Crompton Greaves, as also in the case of Anuj Shah 67, taxman.com 38, has taken a view it is clarificatory and therefore retrospective. Ahmedabad Tribunal, I would believe correctly, in the matter of Jayant Murthy, after noting Bombay Tribunal has taken a view in the case of ITA number 870 of 2016, that the explanation is not retrospective, it would apply only to those orders which are passed after 1st June 2015. Therefore, 1st June 2015 position is little more prejudicial to SSC. Nonetheless, please do not equate power of commissioner as that of a petty officer, and therefore what AO would do, he would do. Supreme Court has now recognized that power of the commissioner is far more detailed one, far more stronger, and therefore commissioner would be entitled to take appropriate action. I think with this we already have reached the end of the day, and unless you want me to continue? I think it's 5:15. No, I can continue. I can up to 8 o'clock. No, that's not the idea. So with this, I think let me close it, because if I start the new judgment, it will be at least 15 more minutes, and I don't want to detain you beyond 5:15. Thank you very much for enabling me to share my thoughts with you.
On behalf of the Ahmedabad branch and all the members present here, I would like to express my sincere thanks to our eminent faculty, Advocate Shri Saurabhbhai Soparkar sir, for giving his precious time and sharing with us various judicial decisions of High Court and Supreme Court. Let's have a big round of applause for sir. Thank you so much. On behalf of Ahmedabad branch, I also thank Direct Tax Committee of ICAI for giving us the opportunity to Ahmedabad branch for hosting this National Tax Convention. On behalf of Chairman of Ahmedabad branch, I also thank all Managing Committee members, Regional Council members, and our Central Council members, Shri Dhinal Shah, for their efforts in making this convention a very successful event. I thank all the participants for their enthusiastic participation. I also thank all Ahmedabad branch staff members for their contribution and work and support. Thank you so much.